Okay, picture this. What if your bank just closed tomorrow? You wake up, grab your morning coffee, open up your banking app on your phone, and boom, you're completely locked out. The local branches are shuttered, the ATMs are totally empty. No cash, no access. I mean, for most of us, just thinking about that sends an immediate shiver down our spine, right? We literally trust these institutions with everything: our emergency funds, our businesses, our entire life savings. We just kind of operate under this comforting illusion that our money, once we hand it over to the teller, is 100% safe, locked away in some magical, impenetrable vault. But what happens when reality actually shatters that illusion? And look, I'm not just spinning some theoretical doomsday movie plot here. This is real, recent Indian history. Think back to the absolute panic we saw during the PMC bank crisis. People were devastated. And then, right when we thought we were out of the woods, the shockwaves of the Yes Bank crisis completely rattled the financial world. And then, just to prove the point that absolute safety is a total myth, we have the Lakshmi Vilas Bank crisis. Families were literally scrambling to survive. Small businesses couldn't even make payroll. A lot of depositors woke up to the harsh reality that their blind, unquestioning trust, well, it might have been misplaced. So hey, welcome to The Explainer. Today, we are tackling this exact fear head-on. We're looking at the 5 lakh shield, safeguarding your bank deposits. Because look, while these bank crises are genuinely terrifying, you absolutely do not have to just sit there and be a helpless victim if your bank starts failing. By the time we wrap up this explainer, you're going to understand exactly how the system is wired to protect you, where the very real limitations of that system lie, and most importantly, how you can take proactive control of your own financial destiny. All right, so here is our roadmap for today's explainer. We're going to start by unpacking the bank's safety illusion. Then we'll enter the DICGC shield. After that, we're reading the fine print, looking at the global context, and finally, we'll wrap up with some actionable wealth protection strategies. Let's jump right in. Section 1, the bank safety illusion. Moving on to Section 2, enter the DICG shield. So here's the reality check. Banks are businesses, right? They take your deposits, they lend that money out, and, well, sometimes those loans just go bad. And if too many of those loans go bad at the same time, the bank fails. It's that simple. Now, when that happens, the government knows that total panic could cause a massive run on other banks and basically grind the entire economy to a screeching halt. So enter your ultimate backstop, the DICGC. That stands for the Deposit Insurance and Credit Guarantee Corporation. When you put your hard-earned money into an Indian bank, this is the specific entity whose sole job is to insure those deposits. If your bank suddenly goes under, the DICGC steps in so you aren't left holding an empty bag. And listen, this is a massive, massive but. This insurance definitely does not mean every single rupee you have in there is automatically safe. This brings us to the most crucial point, and it's this exact number right here, 5 lakh rupees. That is the absolute hard limit of your shield. The DICGC ensures that each depositor is insured up to a strict maximum of 5 lakh rupees. And by the way, that includes both your principal amount and your accumulated interest. But here is the critical detail that catches so many people off guard. This limit applies per depositor, per bank, not per branch. So if you've got, say, 3 lakhs sitting in your local neighborhood branch and another 3 lakhs in a branch across town, but it's the exact same bank, you only get 5 lakhs back total. The other 1 lakh? Yeah, you're basically standing in a very long line with all the other creditors, just crossing your fingers and hoping to recover pennies on the rupee. Okay, Section 3, reading the fine print. Because, as we all know, the devil is always in the details. There's a very strict dividing line when it comes to what's actually protected. Now, the good news is your standard fixed deposits, your joint accounts, and even deposits you hold in recognized cooperative banks, those are completely covered under the shield. But, and this is super important for our non-resident Indians tuning in, if you're using NRE or NRO accounts to manage foreign income, those funds are completely excluded from the DICGC coverage. Period. No shield for those. Knowing this exact distinction is absolutely vital, because the last thing you want is to falsely assume you have a safety net when there's actually nothing there. Let's zoom out a bit for Section 4, the global context. You see, all over the world, governments use very similar agencies to prevent massive bank runs. In the UK, they've got the FSCS. Over in the European Union, they use the DGS. But here is where we see a pretty stark difference. While India's limit is firmly capped at 5 lakh rupees, if you look at the US, their FDIC protects deposits all the way up to $250,000. Guys, that's over 2 crore rupees. Seeing this global framework really highlights exactly where we stand. As an Indian depositor, you are bound by a comparatively strict local limit. And what does that mean for you? It means you have to be vastly more proactive. You literally cannot just rely on a shiny bank's brand name to save you if things go south. Which brings us to our final and most important part, Section 5, Actionable Wealth Protection Strategies. Look, if your life savings exceed that 5 lakh threshold, and honestly, if you're saving for retirement or a house, it absolutely does, you just can't afford to be passive about this. So step 1 in your defense plan is the most immediate workaround. You've got to spread your funds across multiple banks. Remember that rule. If you put 5 lakhs in Bank A and 5 lakhs in Bank B, you've just successfully shielded the entire 10 lakhs. Step 3 on here is just good financial hygiene. Keep a meticulously updated list of all your accounts. You always need to know your exact exposure at any given moment. But I know what you're thinking. What about step 2? What if you have a lot more capital and you really don't want the headache of managing like 10 different bank accounts? Well, that is exactly where you utilize secure government schemes. We're talking about incredible wealth preservation tools like the Public Provident Fund, the Senior Citizen Savings Scheme, or sovereign gold bonds. See, these aren't your typical commercial bank deposits. These are backed by the sovereign guarantee of the government itself. By moving your excess cash out of those standard savings accounts and shifting it into these vehicles, you effectively bypass that commercial bank risk entirely. Why? Because the government, unlike a private bank down the street, simply doesn't default. So here's your biggest takeaway for today. Go look at your account balances. Today, seriously, if you have more than 5 lakh rupees sitting in any single bank right now, this exact vulnerability affects you. Don't wait for the next banking crisis to hit the front pages of the news before you do something about it. Spread out your risk, take advantage of those government schemes, and please share this explainer with just one person in your life who really needs to know this. I'm going to leave you with a final provocative thought to chew on. Is the mere convenience of using a single banking app on your phone truly worth risking everything you have spent your entire life building? Think about it, protect your wealth, and I'll see you in the next explainer.